Welcome everyone for joining us today's investor webinar for our new opportunity. My name is Loomba. I'm a commercial real estate investor. I'm a founder and CEO of Loomba Investment Group, a private equity investment firm. We specialize in real estate syndications with special focus on multifamily. I'm a former IT professional and a professor. And I do have this niche, with my corporate or entrepreneurial experience. I'm very familiar with professionals or busy professionals' distinct challenges. And I do have a strong ability to connect the dot. My goal is to provide investors with the right knowledge to be able to make wise investing decisions aligned with their long-term financial goals to achieve the financial success that they're looking for. So far, I had a really exciting journey in the real estate. Once I started this journey about 3 years ago, I think 2.5 years ago, when I quit my W-2 job, and I jumped into real estate full time. I went 2 full cycles this year, one in 11 months, one in 18 months, and with excellent returns for my investors. And now I would like to introduce my business partner, Hemal Vidyani, and we have been together on multiple deals. Those all deals are doing really well. Hemal, would you please introduce yourself?
Yeah, absolutely. Thank you everyone for joining. Whoever can join right now. I know it's nighttime in Eastern Zone and evening, so an investment of your time is much appreciated to learn about this project and opportunity and learn about us. And thank you, Vinky, for your partnership on multiple projects, including this one. So my name is Hemal Badiani. I'm a real estate investor. I'm founder and CEO of Exponential Equity, a real estate investment firm focused across multiple asset classes, mainly in the North and South Carolina market, specifically 2 to 3 hour circle around Charlotte, North Carolina, where most of my leadership team resides. We are a team of 13 people in the company, vertically integrated on construction management in land and existing multifamily acquisitions projects. And this is one of the projects that's 20 minutes away from a project that we just acquired. So I'm excited to continue that acquisition along this I-85 corridor, which we'll speak about. On the personal side, I'm father of twin kids, boy and a girl, 7 years old. I'm a terrible golfer. I love golfing though, and I love reading books and music.
Great, thanks, Hemal. So before we get started, I would like to go through a small little disclaimer. I'm going to share my screen. Let's see here. So this session is strictly for educational purposes and should not be considered a legal, accounting, or investment advice. This session does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. The strategies mentioned in the presentation may not be applicable for everyone. The information presented is believed to be accurate and reliable. We make no representations or warranties, expressed or implied, as to the accuracy of such information, and we explicitly disclaim any and all liability that may be based on such information and or errors or omissions thereof. Please consult with your own attorney, financial advisor, and CPA for legal matters, investments, and specific tax situations. This is strictly an educational session, or I would say more like a knowledge sharing session. So before we get started, I have one more item. Some housekeeping items for us is, as we go through the deck, you might have tons of questions when you're going to walk through this opportunity. Please use the Q&A box for any questions instead of the chat box, because questions tend to get lost in the chat box because it's open for everybody, so you can chat with other people. And we'll try to address all your questions after the presentation. If we didn't get to your questions for some more reason, please send me an email at vinky@loombainvest.com and we'll provide you with the answers. This webinar will be recorded and recordings will be sent out to all. Recordings will come from winky@loombainvest.com or from the Loomba Investment Group. So, to avoid the emails to end up in your spam or promotions folder, please whitelist my email. And this is it. So let's move on to our exciting opportunity now. We are really, really excited to bring you another opportunity, and this is a Class A opportunity. It's a build-to-rent community, and I would say some fancy term for this is a horizontal multifamily. Cheslyn Place is a newly constructed build-to-rent community, which consists 49 duplexes or 96 units. All are 3-bedroom, 2.5 baths with 1 car garage. The construction was completed in July 2022. This property is located in Spartanburg, South Carolina, only 15 minutes to downtown Spartanburg and 35 minutes to downtown Greenville. With an easy access to both I-85 and I-26, this location is very desirable for anyone wanting to work and live in Greenville or Spartanburg Metro. Spartanburg is a growing community with a small town southern charm. According to Good Hire, Spartanburg is among the top 10 places to live and work in the nation, as is ranked second for growing job markets. So we're going to take you through our pitch deck and help you understand the whole deal end to end. Himal, would you please share the slides? And then if you can share with us, how did we get our hands on this deal?
Yeah, absolutely. Can you everyone see my screen here?
Yes, we can see it.
Okay, so Cheslyn Place, Spartanburg, this is a development community that was constructed in 2022 by a local developer, INA Developers. And they actually are just focused on the Spartanburg and Greenville area. So they're a small time developer, 4 to 5 projects at a time type of deal. And usually these types of deals go to the big players like JLL from a brokerage perspective. But this developer had great relationships with a local broker, Lee and Associates, that kind of put out the deal to the market. So not many people fortunately got to see it. Our acquisitions director got their eyes on it and quickly, realizing that this asset is 20 minutes away from the one that we were acquiring at that stage, really went ahead and got in aggressively to understand what the actual deal is with this opportunity and quickly put out an offer. So we won against many people that should have looked at the opportunity. And because of that, we got at a really optimum price, and we kind of talk through that on why we believe this is such an optimum price.
I know, and it's pretty exciting. And it's a Class A property in an emerging market. Can you please share that slide where we talk more about the market?
Yeah, absolutely. So let's kind of talk through the market, right? So Spartanburg County, just to give you guys macroeconomic situation, right? So if you think about, if you're on the West Coast, you should look at the San Antonio, Austin corridor as an analogy. In the South side, connecting Atlanta to Raleigh, which is a 5-hour duration of commute, is this I-85 corridor, which is strategically being expanded, and specifically being expanded with all these pivoting from globalization to more local presence of manufacturing industries and automobile industries and any other plants that are coming up. And Spartanburg, Greenville, if you think about it, and Charlotte to some extent, is falling right in the middle of that area and allowing us to have just job after job. I think recently BMW just announced a $1.7 billion, largest in the world, plant in this area in Spartanburg, right? So we'll kind of talk through it. Spartanburg as a town is sitting right as a sister city to Greenville. Greenville expanded tremendously over the last few years, and now all that growth is kind of bleeding into Spartanburg and North Spartanburg, and at some point Charlotte and Spartanburg and Greenville will kind of converge, right? And that's the same story on the north side of Charlotte with Greensboro and Winston-Salem, where we own actually 400 or 500 units ourselves, on the other side. So our bet as a company is up and down this I-85 corridor in terms of development, in terms of purchasing land, in terms of existing acquisition, because we are very bullish on what's happening over the next decade and currently in terms of the number of people that are moving there. And because of that and the growth that this area is seeing, the number of jobs that are being created, the number of families that will be needing housing of one fashion or the other.
Yeah, you can even take us to those slides, where we have this multiple jobs, about 20,000
Yeah,
jobs created in the
jobs
market.
galore,
Yes.
right? So
Yeah.
Walmart, Nestle, Oshkosh B'gosh, Hall Corporation, BMW, like I mentioned, they already had a $200 million plant there, and now they're expanding into 1.7 billion, the largest facility in the world, which is unbelievable. So, DHL, flooring, I mean, these are just in the last couple of years, they had $6 billion and 20,000 jobs created. These are direct jobs. Now think about the indirect jobs that will be created for restaurant industries and other things, construction jobs that are coming up. And it's just mind blowing. If you ever get a chance to kind of go through that I-85 corridor up and down, it's always under construction. It's getting more and more lanes. And every place you're seeing cranes coming with the industrial warehouses and fulfillment centers and other things that are just coming up. So again, our bet, and we could talk about the 10 different projects we have across. So we are very consistent as a company on where we are looking for in terms of market. And this is where we want to be.
Awesome. And it's such a beautiful property, right? Can we share those slides as well?
Yeah, absolutely.
What it looks like, yes.
Yeah, so this one, it not only sits on the I-85 corridor, just to let you know, there's also an Interstate 26, which takes you to Asheville. So Cheslyn Place as a property kind of sits here. It's a little south shown here, but it's essentially at the cusp of 85 and 26. And what that does is you can be in Asheville up on the mountains, vacationing in an hour. You can be in downtown Greenville in 30 minutes, downtown Charlotte in 45 minutes, downtown Spartanburg in 20 minutes. And you have Topgolf and other Class A facilities a couple of miles away. So beautiful, beautiful location. And the property itself, typically, we would, when we do construction, and we are doing a similar build-to-rent community construction, about 35 minutes from this asset in Gastonia, North Carolina, near Charlotte. So we know what the construction cost looks like, right? And such a property with high-end finishes, the black finishes, and the white cabinets, etc. Our property at this stage would be around that $220 a door in terms of construction. So for us to buy this at, that $244 a door type of price, $240 plus a door price, is just unbelievable, right? As a developer, I would really want to keep $50,000 to $70,000 per door margin. So if we are building this, we would be selling this at least $300,000 for it to make a viable project, even in a down market. So we are getting this at an attractive price. But look at all the finishes, right? Everything that you can think of in a Class A plus apartment is available. This is their kitchen's photo, all real pictures. They have a one-car garage, and it's a duplex finish. And this is deeded separately. That's the advantage of a build-to-rent community or an apartment building. You cannot sell an apartment at a time, unless it's a condominium. But a build-to-rent community, and that's why the hedge funds and the Blackstones of the world love this asset class, is these are deeded at one single asset at a time. So you can, in theory, sell this townhome separately if there's any big risk or anything happening, or as an exit strategy to be flexible and sell 10 of these and keep the rest 88 as a build-to-rent community, as an example. So there's a lot of things you can do with a build-to-rent community with the same concept, but that you would not be able to do in an apartment community.
Beautiful. Yeah. So let's talk about your business plan, because a lot of people that think it's a Class A opportunity, brand new, right? Brand new finish, looks awesome. Where is the value add? How are we going to add value? What is our business plan? Let's share that.
Yeah, so Class A apartments or any community that's Class A plus, typically you would see an IRR return that's lower, right? Typically in the 13 to 15%. And that's because you're essentially going into a low maintenance, risk-free asset from a physical inspection standpoint. And this property was finished in July of 22, so it's such an asset. The value add comes is where these developers are, their modus operandi always has been, spend money in 4 to 5 construction projects. And the moment it's done, kind of lease it up as much as they can, but just get it under contract and sell it off, cash out, and repeat the stuff with their own land, pieces of land that they've been owning for generations. And that's a great strategy for them, but what makes them is not so great property managers. And for lease up strategy, this asset was finished in July. It's already 99% occupied. And what that means is they have leased, 20, 30 leases at a time over the last 3-4 months. And for that to happen such aggressively, they've kept the rents really low. So they started with $13.95 as rents and now pushed it, most of the rents at $16.95. They've even tested a couple at $17.95 and $18.95. So those are low rents. We know that because we run through the comps. Plus, they're not charging any ancillary income. Your standard pet fee, your standard admin fee, the monthly pet rentals, nothing fancy, right? It's just standard stuff that any property, any asset that you kind of go to in the market, in this submarket, you should expect to pay those. So what our business plan is to essentially, wait for those two turns. Currently, the pro forma is around that $16.95, taking the most of the rents. We want to push it to $19.95, and the rent comps are right now at $1,900 to $2,700. So we believe that's super possible. We want to do it over 18 to 20 months period. So we want to utilize 2 springs and 2 summers, 2023 and 2024, so that as the leases come due, we want to keep the occupancy above 90%. But as the leases come due, we want to start renewing them with more market rents or more ancillary income that should be there in the first place, but these guys haven't charged because they wanted to lease it up. And then, spend CapEx. Again, this property, we did the entire physical due diligence. There was 0 inspection report coming out of that, right? There was nothing. It's a brand new property with all the home warranties and appliance warranties and roof warranties that we'll get for the next 5-10 years. So there's not much from that standpoint. However, they've done not too much in the landscaping space, so that we could use a lot more trees and shrubs to beautify the property a little bit. And then we want to add some dog fencing and privacy patios in the backyard, so privacy fencing in the backyard of each of the townhomes. That allows, we want to create this as a pet-friendly community, and that allows us to charge a little bit more in terms of a premium rent. Now, obviously, that's not underwritten in our model or the financials, but we want to aim for that so we can push the rents beyond 2,000 if we can, and then maintain stabilization. Right? There's no reason. There's no bad tenant. They have 0 delinquency. It's cash flowing day one. There's no reason to rock the boat in this volatile environment with, bringing low quality tenants, taking them out and bringing high quality tenants in. There's nothing of that sort that needs to be done here. So we want to focus on keeping the occupancy above 90% while we do that slow 2 turns over 2 springs and 2 summers to push the rents where it should be in the first place.
Great. And then we do have a proven concept as well, because it's the current rent that they tried like 18 something already, right?
Yeah.
Without all these bells and whistles that you're talking about. Can you show us the rent comp slides as well in the areas? We're pretty low, right, in the market.
Yeah, as I kind of show just one slide here to show you the lease roll-off schedule. So when I say 2 springs and 2 summers, you kind of see that most of the leases between March and August are being due. So as these leases come renewed, we're actually waiting for that. And once that happens, we'll get to the pro forma rents that we want. And we'll repeat this cycle 2 times in so 2023 and 2024. But yeah, rent comps, Artisan Living Longview, I'm just going to go here. This one is charging $2,000 in rent, 6 townhomes at a time together, clubbed together. So from privacy standpoint, both your walls are almost like an apartment in terms of noise and privacy, versus the 2 duplex style that we have. They do have a pool, but they don't have any dog yard, patio, or walking trail, which we have. The towns at Converse, again, 2020 built and charging 1,830 already. They're pushing 2,000 soon in December. If you go to their website, that they don't have any amenities at all. And so, you know, where we are is that 1,695 right now, and where we want to be is pro forma. So we'll still be pretty low in terms of rents when it comes to all the other assets we have here. Some of them have slightly larger units, but some of them are actually similar size to ours and are actually apartments. So they don't even have a garage. When we say 1,366 square foot, that's without the garage, right? They hit that square footage. So these are, if you take the garage into consideration, that's 1,500 or 1,600 square foot in terms of total space.
And also we have very conservative project assumptions as well. If you can share that slide as well.
Yeah, absolutely. Yeah, so our assumptions, we already have a loan secured, and then I'll talk about the loan because a lot of people want to know about the debt side, right? So when you think about debt right now, you have 2 options. One is the agency route, which is Fannie Mae or Freddie Mac, which with the recent November increase, you would probably get 6 to 6.5% interest rate in that, from an agency fixed debt perspective. For that 6.5, and by the time we close in December, if you don't close by December 14th, you might even push more than 6.5. That's how the rates are, right? Plus, you would get only up to 50% leverage, because Fannie Mae and Freddie Mac look at the historical financials and the historical NOI. And this property's historical NOI is only a few months old, but there's not much we can do right now because most of the leases are 12 months to change that NOI. So while the NOI is great, there's not much we can do to improve that. So the agency would only lend us probably 45 to 50% leverage. Plus, they would charge us prepay penalty, lock us in for 7 to 10 years with yield maintenance and defeasance. So whenever the Feds, we all know at some point in the market cycle, maybe it's 12 months from now, maybe it's 2 years from now, the Feds would have to bring down the rates at some point as the economy cools down significantly, to pump it back again. That's how the market cycles work. That's how they worked in the last 9 or 10 recessions, and that's how they will work this time around. We don't know the timing of that, but we want to be flexible in coming out of the loan, take advantage of that lower rate whenever that happens, if we choose to refinance or choose to exit without any prepay penalties or anything of that sort. So we reached out to a REIT lender, Benefit Street Partners, which is direct arm of Franklin Templeton, which is a hedge fund, one of the largest in the world. So they have extreme certainty to close. And we actually negotiated a very, very flexible debt term. So first of all, we got a higher financing, which is 16 million, which is about 68% of the purchase price or 60% of the overall cost of the project, which is not too high of a leverage, but better than what the agency would have provided. The second thing we negotiated was a lockout period, which is only 6 months, which is unheard of. Most of the lockout periods is 2 years or 3 years or 18 months at the very least, where it says, whatever happens, you cannot refinance before 18 months of this loan or 2 years of this loan. We actually negotiated a 6-month period, which allows us, after 6 months, anytime the Fed reduces their rate, we can choose to refinance this loan or someone else if we go and sell this asset, which is phenomenal. And the third thing is, we got the SOFR rate, while it's a spread, the spread reduced to a very low percentage. So most people charge, they want to earn 5% over the actual rate of the floating rate. We negotiated a 4.25 spread, which is again, significant when it comes to a $16 million loan, 75 basis point. So what all of that does is allows us to be lower than 8% right now and buy a cap insurance for only 2 years. If we choose to go beyond 2 years, every year we can buy another cap rate insurance. So we're not spending upfront more than 2 years worth of money on the cap rate insurance, and also have that flexibility to continue with this loan, right? If Feds don't do anything for 2 years or 3 years in terms of reducing the rate, then we should be able to continue with this loan no problem. And that allows us to effectively have a fixed 8% rate, which is what we have underwritten all the numbers at, with up to a 5-year term and a 5-year interest only period. So between 6 months and 5 years, anytime we can exit, no penalties, anytime we can refinance, no penalties, and the rate between a 6.5% of Fed's rate and an 8% of bridge debt rate is pretty marginal when it comes to difference, right? With regards to what the numbers look like. So that is one of the biggest reasons why we can allow for a superior return on a Class A asset than your typical, if you go to a big hedge fund type of website like Yield Street or something, you will see typically the 15% IRR type of return for such an asset.
Great. I love that. And then, with all this flexibility, even going to the agency or sticking with it, and with the, we do have a plan to exit year 3. You want to talk about it right now?
Yeah.
Let's do it right now instead of later. So we're looking a 3-year hold for this property, and then I would just refer to the sensitivity analysis too at this point. Then we'll move on to our returns for the investors. I know everybody's waiting patiently for that.
Yeah, absolutely. So let me try to get this working. Yep. So it's a 3-year exit is what we've assumed. And I'll go to the sensitivity analysis first to kind of give you that metric, right? Mm-hmm. So we are looking at 1.62x. So 21, almost 21% annualized return over 3 years at an 18.5 IRR is what we are assuming at that 5.25 cap. Again, most of the, Greenville used to trade at 3 cap on a Class A deal. We want to make sure we are being uber conservative when it comes to new Class A, and even in this market, right, which hasn't moved much in terms of reduction of the cap rate or increase of the cap rate. And so year 3, 1.62x is, so, $100,000 would get you $162,000 back at 5.25 cap at a year 3 exit. Now, this allows us to take advantage. We believe that between now and 18 months from now, our projection is that the Feds would start reversing their policy. And once they start doing that, cap rates are going to compress again, and the market's going to get hot again. That's how the cycles work. And that would be a good prime time to exit. But this is also a great asset to hold for a longer period of time, right? And if at that stage we can refinance and take chips off the table for all the investors, they will still enjoy perpetuity equity stake in the project and cash flow from that deal. So it's like buying 100 single family homes, essentially, is what we're proposing here.
Okay, so let's share the returns as well, those slides that we have.
Yep. So we have 3 classes of investors, which has been typical for us at catering to the 3 classes of investors that we have as a company, right? The first class is this coupon class, which is looking for a 10% fixed return as a pref return, would be paid first before the Class B and C investors on a pro rata basis, and allows them to have a much more consistent return flow, but doesn't allow them to enjoy the equity upside for getting paid upfront, right? So that's the Class A. Class B is a minimum of 75,000. We have a 7 pref, so first 7% of the returns pro rata would go 100% back to the investors. Then we have a 70-30 split up to a 14 IRR, and after that, every dollar we earn is split up 50-50. And that allows us as general partners to be incentivized and aligned with the outcome of making this an uber successful project. So we want to knock it out of the park and make it 20 IRR if we can, because that 50-50 split is alluring to us. And then for some of our larger check investors, we have a class C, which is 500,000 above funds, etc., that have been typically partners of ours. That would enjoy a slightly larger pref instead of 7 pref and 8 pref with all the other metrics similar to Class B from an investment standpoint.
Great. And it has 100% depreciation. Can you talk about that too? When do
Yeah.
people expect the K1 and what it's going to look like on the cost seg perspective?
Yeah, absolutely. That's the exciting thing. This is one of the deals that would close this year. So 100% bonus depreciation would be awarded. And so your K1 should come out negative. We typically pass out the K1s in February or March of the next year, right before your tax season. So you can use them for your personal tax returns or business tax returns as you choose. This one is, as a full disclaimer, it's a newer asset, right? So we don't take pref equity positions or anything of that sort. So we, in a newer asset, more of, if you know about cost segregation, newer asset, more of the structural stuff goes into the longer depreciation period, and less of the stuff is, you know, the value add component that you would typically depreciate a little bit more. So instead of enjoying your 40-50% depreciation for $100,000 investment, typically you would give out a $50,000 negative K1. This one would be a little less, probably around that 30,000 mark, but it will still be an advantage to whoever wants to invest in this project.
Great. So I'm going to ask you a couple questions before I move on to the audience. So share with everybody, what is one best thing that we really, really like about this deal?
Yeah, it's the combination in this environment. I want something that I don't have to sink in money with unpredictable older asset, right? With cast iron plumbing or anything of that Class C type that we have typically invested in the past couple of years during COVID times and really done well with it. But we want to stay away from, given that the cost of construction and renovation is so high, the cost of labor is so high. And so that the combination of that low maintenance along with a day one cash flowing, right? It's not a construction project. It just finished. It smells of new paint, right? So the people living there are excited. It's filled with families and cars. And so that allows that stability of predictable cash flows at a baseline, which we're going to increase. Again, so from a risk and volatility perspective in this environment, you want something that is low maintenance and cash flowing day one. And this is that asset. So we love that.
Good. I love that. And I'm going to ask you one worst thing that could happen.
What's the worst it could happen? Any asset, any investment that you could have in real estate or otherwise, right? The things that could go wrong are your schedule or business plan could be longer, your returns could be lower, or whatever you're trying to do from a top line or bottom line perspective could be different than your projections. So this is no different, right? Well, again, our assumptions and projections are based on tremendous amount of experience, knowing an asset 20 minutes down the line, which is similarly sized 96 unit apartment building, 97 vintage that we just bought. So we know who we can place as a property manager, who we can place as a maintenance person. We are building a similar community of 100 homes, built to rent community, 35 minutes from this asset. So we know what it takes to construct such an asset. So all those factors are still there from our experience to make it as good a projection as we can and as conservative assumptions as much as we can.
Thanks, Hemal. I'm going to open it up for everybody. If you have any questions, please put it in the Q&A box if you are with us in the live webinar on Zoom. And our social media friends, please put your questions in the comment section and I'll ask Hemal This is your time. Please go ahead and do that. Let me check. I do not have any questions, Himal, at this time. Let me see on the social media, because we do have a lot of people watching us. I don't see any questions. I do see one question. Who would be the potential buyer at exit?
Yeah, that's a great question. So institutions are gobbling up this asset for sure. That's one potential buyer. Or real estate syndication is getting into the build-to-rent community space in big time, as they understand the flexibility that I mentioned before versus an apartment community. So we are building many more build-to-rent communities ourselves. And we see a lot of players in the Southeast Sun Belt that are non-institutional real estate investors that are getting into this. So it'll be another real estate investment from institutional, otherwise that would be the exit buyer.
Great. Thank you. Let me see. If there's any other questions? Okay, there is. Jeff says that's awesome, guys. That's on the social media.
Great.
So far, no
Thank you.
questions. I'm going to remind everybody, if you have any questions, please put in the Q&A box. And our social media friends, please put your questions in the comment sections so we can address it here for you live. Okay, so I'm just juggling back and forth to figure
That's
out if
okay.
there's any questions on YouTube or LinkedIn.
Which is great. It's as straightforward an investment as it comes, right? There's
Mhm. I mean, it's like super awesome deals. I really like this deal, really sweet deal. Yeah, I do not see any more questions, Hemo.
okay.
Would you like to add anything else for our viewers, our investors?
No, I think we've covered most of it on the project side. I will speak about our track record a little bit. Exponential Equity, like I'd mentioned, we have 13 people in the company. We own and operate about close to 1,000 doors, 1,000 units. Most of them are within 2 hours of this asset. So we have the property management in place. We have the professionals and resources and the vendors and strategic relations in place. We also have $85 million in construction of different sorts going on in the Charlotte MSA, which is about 45 minutes from this asset. So again, we have that kind of expertise and vertical integration building and bringing to this table. And that allows us to really hone in on the operational elements of any asset, right? So buying an asset right from a purchase perspective, with the relationships that we hold with the local influencers, the local economic development, really trying to change the game for the Carolinas as a market across multiple asset class. That's our vision. And then managing these assets at the great operators. Anybody can make great returns in the markets that were there 5-7 years back, because the market carried most of the deals in terms of where it was and from a pricing standpoint. Right now, the great operators would define themselves and differentiate themselves in terms of how closely they run the operational expenditures, how they can eke out some level of gains to lower that expense, to increase that bottom line, all things being equal. And we pride ourselves and the team we have formed to be able to do that across all our assets. So we are excited to do that with this asset as well.
Great. Thank you, Hemal. I do not see any more questions. Let me ask one more time to the audience. If you have any questions, please put in the Q&A box. And our social media friends, you can add it into the comment section so we can answer your questions live. I'm going to give it another minute.
Go to our track record in the meantime.
Yeah, I do not see any more questions. I think we pretty much covered everything to the best of our knowledge. And if you do not have any questions right now, but if you come up with any questions later on, you're welcome to reach out to us anytime and we'll be able to answer it for you. There is a question from Elise. Is this opportunity for non-accredited investors? Yes, Elise, it's 506C for accredited investors only.
Correct.
And thanks for that question, Elise. Actually, we should have mentioned that this is a 506C. That's the reason we are all over the social media as well, because we are allowed to advertise this property or this deal. So if you have any questions, not at this time, but later, anytime, please reach out and I can share my contact information, how you can reach out to me here. Okay, there you go. You can send an email to winky@loombainvest.com, or you can use my phone number to call me at 925-250-3907. I will love to hear from you, and I will love to answer any questions regarding this deal.